Well, hello, good morning, and welcome to this Bristol Life Business Surgery. It's an M&A special about buying and selling businesses with Royds, Withy, King. Delighted to welcome you this morning. We hope it's a timely and useful exploration of the opportunities, the processes, the thinking and the factors around buying and selling businesses, as well as a discussion featuring practical advice. We'll also be delving into some of the unconscious biases that both buyers and sellers have and how to counteract them. Is now a good time to sell or to buy? Perhaps valuations are conditioned by pandemic-related tough trading. Perhaps some owners just want out. Conversely, the glut of capital out there needs to find a home, and good assets will always command a decent price. Now, whether a buyer or a seller, how do you decide to handle this most singular of transactions? Who would you choose as your advisors? All this and more shortly with James Worrell and Ian Butler of Royds, Withy, King. Firstly, some updates and some news. It's now barely 3 weeks until the Bristol Property Awards, which are part of our new Bristol Property Symposium. Please take a look at the new issue of Bristol Life out on Friday for an extensive preview. Remember, sponsors have tickets included as part of their deal, and all finalists have a pair of tickets for free to go to all aspects of the symposium, all three. Thought leadership, which includes exclusive insights on property trends, networking, gosh, the opportunity to talk with hundreds of professional services looking for contacts and businesses, particularly in these times, is very valuable. And then, of course, the Bristol Property Awards themselves. If you want to join for keynotes, awards, and to meet with that greatest array of Bristol professional services since those pre-lapsarian times of 2019, please take a look. Let's give a nod also to our sponsors, the headline sponsor, Smith & Williamson, plus Close Brothers, who are the winner of winners, then AWW, Blaze Commercial Finance, Cotswold Homes, Horsall Construction, Juniper Homes, Marsh Commercial, MDA Consulting, Optima Systems, Original Style, Origin Workspace, Rate Setter, Planning Portal, Royds, Withy, King, our hosts as it were today. We'll be talking with them about that shortly. Shawbrook Bank, Spaces, Vickery Holman, Wilmot Dixon, and YTL Developments, as well as Triangle Networks as well. It's a great array of companies, all of whom will be there, all of whom you'll have a chance to talk with at the Bristol Property Symposium on Feb 12th. Big news yesterday we announced, which is the Bristol Life Awards. We have thought about this carefully about when to run those, and we have put them back until September the 16th. We think it is much better to have certainty than to keep chasing the sunset on dates. Have a look at, there's a YouTube video which we posted yesterday of the launch event, and also check the awards site where you'll see details of any remaining sponsorships. This year, of all years, is a great time to come on board and stand tall as a proud Bristol company. Noms are also open via our website. Momentum is building very much. A couple of things on business clubs and surgeries. Our next Bristol Life Business Surgery with telecoms and business communications company Blackstar is on Feb the 3rd, and we'll be joined then by one of their key clients, Ashton Gate. It will be a really interesting session. Talk to us, please, if your company would benefit from a deep dive at Bristol Life Business Surgery about your expertise. It's apparent to us all, I think, businesses are more receptive now to suggestions about how they may structure and run their businesses. So it's a great time to get in front of them. There's also the next Bristol Life Business Club on February the 15th on health and wellbeing. Right, preamble over, on to our business surgery. Please send in your questions using the Q&A button below. Clearly, some of this may be a little sensitive about potentially selling businesses and so on, so questions can be anonymous. Please mark that if you wish. Or if you wish to be named, do add your company name to the question if possible. That would help us give context. As our two speakers step forward, which is my nod to them to unmute and devidify, if that's a thing themselves, I'll just run through their bios. We're joined today by James Worrell. Morning, James. A partner in Royds, Withy, King's corporate team, specialising in domestic and cross-border mergers and acquisitions, corporate structures and group reorganisations. He acts for UK and international corporates and shareholders, a range of domestic and cross-border corporate finance transactions. And there also is Ian Butler. Morning to you, Ian. Also a partner of Royds, Withy, King's corporate team, specialising wide range of corporate work, including UK cross-border mergers and acts, and shareholder arrangements, JVs, private equity, venture capital transactions, particular experience advising tech businesses, academics, entrepreneurs, founders, and management teams. Welcome to you both. I hope this finds you in sort of reasonably good shape personally. And I'm going to begin with a personal question, which is this. What actually attracts you individually to M&A work? Isn't it rather fraught and stressful? Maybe that's the attraction.
I mean, certainly from my perspective, it can be sort of, there's always parts in any transaction journey that do tend to be fraught, and there are sort of the pinch points in any transaction where in normal times everybody's round the table and there can be some difficult conversations. But I think sort of from at a personal level, so I've been at Royds with the King in the corporate teams, so working on transactions for 10 years now. And I think what certainly from the outset, it has always attracted me, it's sort of very much the collegiate nature of M&A work. It's a situation where in most transactions you've got the sellers, the potentially founding shareholders, you've got a potential buyer, or it might be an investor. Alongside that, you've got the professional services advisors. So you've got the legal teams on buy and sell side, corporate finance teams, tax teams, all with slightly different specialisms, slightly different agendas, interests in respect of the transaction, but fundamentally all aiming to get to the same point, completion of a successful transaction for everybody involved. And that does, certainly in the majority of cases, result in a very collegiate approach from everybody concerned with the transaction. And I think as part of that journey, I think certainly the personal level, what's always enjoyable is working with, often the case, certainly working with sort of founders of businesses, with the shareholder team, because often, certainly the sell side process, it's normally once in a lifetime. It might be the definition of 10, 20, potentially 30 years of long hours, hard work, creating, establishing a business and going through that journey, and to be a part of that at the end and to generally seek to be that sort of trusted advisor to guide them through that exit process, and seeing the deal come to fruition, and often the case, that sort of life-changing realization of capital is very, very satisfying to be a part of. I think alongside that, you do have, as I mentioned, sort of the obstacles that you sort of come across along the way, but equally it can be a challenge, but equally it's sort of in its own way, it's where you seek to add value as the professional services advisors. That's what the lawyers, the corporate finance advisors are there to do, is to seek to protect the client's interests, so the seller's interests, protecting the capital coming to them from the buyer's perspective, protecting the asset and ensuring that it is what they think they're acquiring, but also overcoming the obstacles which occur on every transaction. There are always obstacles, hurdles that you need to clear, but it's how the transaction advisors add value is supporting the clients past those obstacles and towards hopefully a successful conclusion.
So Ian, it's a collegiate, if occasionally complicated journey. Is that part of what attracts you too?
We come from a similar place, Greg. I think everything James says resonates for me as well. It is all about selfishly doing deals, helping people, and achieving success. That's what it really boils down to at the end of the day. And those are things, when you think about lawyers and M&A transactions, that you might not always think that would be our main drivers, perhaps, because you think of the lawyers as the paperwork. But for us, I would say it's helping people, seeing successful outcomes, watching businesses, achieve transformational transactions, and being a part of it.
Well, for those watching this who perhaps haven't been involved in buying or selling businesses, but perhaps contemplating, I'd just like to echo that point, having been involved on both sides myself. The paperwork is to some extent almost the outcome. It's almost the iteration. It's the thing that keeps people on track. But the value of a great advisor is that they're there with you in the trenches, because every single transaction is bespoke and different, and every single transaction needs some great advice at different times. So let's talk about where we are at the moment in terms of M&A work in the last, few months, last couple of quarters, compared with other years. How have the inquiries, instructions, even transactions been in these pandemic times? Again,
I think certainly speaking at a Southwest sort of level, I think it was certainly 2020 was a year of two halves. The first sort of 6 months, the uncertainty created or that arose certainly during that sort of March, April time, initial lockdown, certainly of course, a lot of transactions we did see being mothballed, paused as everybody took stock, thinking, well, what does this mean for the transaction process, the targets of the company's market, their customer base, and the valuation matrices. I think as we sort of came through the year, certainly then I'd probably say from sort of August onwards, the M&A markets really did seem to sort of rebound and bounce back, and a lot of mothball transactions, the process is re-engaged and continued, and lots of new transactions began starting. I think it's been I think we'd probably say it sort of from Royds Withy King's perspective. I think we are probably, in terms of the M&A transactions we're working on at the moment, looking at the pipeline going forwards, it seems to be a pretty sort of confident, bullish market out there at the moment for buyers and sellers.
Has that surprised you? How, that bullishness or that bounce back or whatever?
I think the speed with which it arose certainly did. I think originally this time last sort of April time, as transactions were sort of pausing, if I'd have been asked that question then as to when will things get back to or look more like normal in the M&A world, I'd have certainly been saying probably looking towards certainly 2021, latter half of 2021, 2022 potentially. The speed with which things rebounded in the second half of last year was certainly surprising, but I think when you sort of look beneath and what the rationale for all that occurring is, fundamentally a good business is still a good business. Yes, COVID presents challenges, but there are some sector-specific nuances, but in a lot of sectors, actually, the impact on a day-to-day basis did not have a material effect. And actually, some businesses certainly looking towards the tech sector, software as a service providers, you have to look at the stock market and see what happens to Zoom, Microsoft Teams, all of these video conferencing platforms, and see what happened to shareholder value there. Lots of opportunities did arise, and it accelerated growth in some sectors in a way that nobody could have foreseen.
Yeah, it's in some extent it's the law of unintended consequences. We don't know until we're in it what it triggers. But perhaps also for Ian, in terms of sectors, James has mentioned tech. Which sectors have been notably stronger or maybe weaker in this time in terms of those transactions and inquiries?
It's not particularly unsurprising, really, when you look at the effect of the pandemic across the board, where businesses have performed strongly and sectors are strong. It plays to all of the sort of the strengths coming through the pandemic. So tech in general remains very strong, and in fact, with the move towards remote working, focus on technical infrastructure, cloud-based systems, all of those sorts of things, there's definitely been that's definitely a market that remains strong and probably stronger as a result of it, as everyone revisits their kind of strategic priorities in that sense. And obviously on the other side, where have there been particular challenges? Well, retail, leisure and hospitality, entertainment industry. We've heard anecdotal evidence across the board that in many of those areas, yes, of course, businesses have pivoted, have turned to do other things quite quickly to maintain the revenue and survival, frankly. But the lockdown generally has had a massive effect on those areas, and it is unsurprising.
And I was going to say, I mean, presumably there are also maybe a little now, but soon to come, more distressed assets, companies that simply cannot trade through this or lack the capital to achieve that. And so would you expect there to be more of that type of class, if not sector, to be coming to market in this year?
There's definitely reasons for deals being done, and the effect of the sort of the general wider market on businesses and their performance is a driver. So we are seeing more market consolidation as businesses bolt together. Fundamentally what James says, a good business is still a good business, but obviously there are short-term challenges in terms of cash flow, revenue. Things will go back to, we expect a sense of normality at some point, but how do you get to that point? So good businesses fundamentally still good businesses, but yeah, you know, consolidation and growth through acquisition is a key feature. So again, through the sectors we talked about, you know, leisure and retail, entertainment, and yeah, the high street generally. And we've seen lots of, you know, lots of opportunities on the high street. You know, lots of administrations, CVAs, all of those things going through at possibly a slightly higher level to where we're particularly focused in the market, particularly in the southwest. You know, our sweet spot is the lower mid market, so it deals with transaction values between 3 and 30 million. So that's where we look at things. But even in that space, yes, there is opportunities. It's just that we think possibly those may be a little bit further down the pipeline, perhaps.
Yeah, so that is probably still to come in the sectors as identified. Clearly, not each of the business operators. There are some extremely smart operators with deeper pockets or longer term strategies who will pilot their way through it. But I wondered about the other motivation. There's multiple motivations for selling. But I wonder if this pandemic has slightly accelerated for the owner-occupied type of businesses. There's almost the existential sense of why they do what they do, and there's been a chance to ponder deeply about their own personal prospects, and that might also be triggering a sense of, you know what, now is the time to move on and go and do some other things. Are you finding that at all?
Yeah, I think we've certainly had some sort of interesting conversations with clients and individuals looking at sort of transactions along those sorts of lines. It is that as those sort of market shocks that tend to occur, you know, it's a highly unusual global pandemic, unlike most people, you know, none of us have seen in our lifetimes. But equally, in sort of years gone by, so the 2000s, you had the Great Recession of 2008, sort of back in the 1990s. These shocks do tend to occur in the markets, and they do tend to prompt that moment of reflection for individuals. Yes, how much longer do I want to keep doing this for? And always the point, certainly from a business owner perspective, where are you trying to get the business to? If an exit is your ultimate goal, where does that point sit in your journey? What does valuation look like? What level does the business need to reach to attract the sort of buyers that you want to sell to, that deliver the sort of pricing matrix that you're happy with? And I think we've certainly had some sort of conversation with individuals sort of looking back in hindsight at 2019, thinking, oh, I wish I'd perhaps hit the exit point then, because actually now I'm going to have to carry on for another 3 to 4 years to get back to what I would have achieved potentially last year in some sectors. On the flip side, you've got some, certainly as Ian mentioned, sort of tech again. You're seeing businesses that are booming as a result of having a very nimble sort of service operations and being able to react to changes in the market. And actually their exit opportunities are accelerating into 2021, whereas originally their plan might have been a 2023 exit. So I think as always, there are winners and losers on both sides from the outcome of what's gone on. But it's certainly the forefront of a lot of people's minds.
And to that point about valuation, has the tougher trading performance, which has been true one way or another for many sectors, clearly not all, but has that been an inhibitor of companies seeking sales? Why place a multiple on a duff year?
I think there's certainly been it sort of caused you end up with buyers and sellers having very different expectations of how the target business will recover, how quickly that will occur, and how quickly it will get back to what it was doing pre-pandemic. So there is that alignment might have disappeared. And certainly where you had valuations that had in principle been agreed back in, say, 2019, being revisited in 2020, that expectation gap is difficult and a challenge to overcome, because the buyer will always be naturally a little bit more prudent, sellers a little bit more bullish. I think what we're certainly seeing in the market as a way to try and bridge those expectations, is an increase in the number of earnouts introduced into M&A transactions. So with the price being based on, or proportion of the price based on the future performance of the target company over 1, 2, 3 years post completion, to almost see were the buyers right being prudent, or were the sellers right in terms of their bullishness about the recovery. So that's been certainly a mechanism we're seeing in the market, a way to try and straddle those differences. And if the parties still want to go ahead with the transaction, get the deal done. But equally, in terms of the matrices used for the valuations of target businesses. It's typically the concept of the multiples of earnings. I think you do end up with those sort of the acronym always EBITDA is what everybody talked about. EBITDAC became the on the agenda last year. So adding and before coronavirus onto the multiple base, was nice. That sounds nice from a seller's perspective, but sort of I don't think many buyers are sort of willing to wear that.
Right. But I mean that point about deals becoming more contingent is pretty much inevitable, I'd have thought, in these times. And for those who perhaps haven't experienced this, how broadly an earnout would work is that a certain amount is paid now on current trading, current performance, and then subsequent is performance related. I mean, other deal structures presumably are a blended average of prior years, and there are any different ways. I mean, ultimately, although companies talk about multiples, these are all just means to an end to a price, and it becomes a price haggle, doesn't it?
I think that's probably fair in general terms, Greg. I mean, the reality is a transaction is reflective of a commercial deal, and what is a target worth? A target is only ever worth what anyone is willing to pay for it, in very, very basic terms. From our perspective, achieving value, particularly on the sell side, is one of our key priorities when we're working on transactions. So again, putting the paperwork to one side for the moment, but coming back to delivering deal, securing value and minimizing risk. Those are the key headlines that we're looking to do, because if we don't do that, we're not going to get thanked for doing it, however nice the paperwork might be. Earnouts are by their nature quite difficult, tricky things to get your arms around. Because whilst they're becoming more of a feature in the market, you've got to define what you're measuring for the purposes of the earnout, and you've got to be looking into the future a little bit. So there aren't many businesses, and this plays into some of the more psychological stuff that we'll talk about maybe in a bit. But integration is often a feature that you think about when you're doing an M&A transaction. It's not that common for businesses, although it does happen, but for businesses to remain in situ in their own kind of ring-fenced sort of position within a buyer's group post completion, or at least for a significant period post completion. But if you're measuring revenue, let's say, as a basic measure for earnout purposes, what happens if bits of that business disappear off into the wider group over time, and how do you keep tabs on that, and how do you keep control of that, and how do you ultimately make sure that it's measurable and definable?
Isn't that the inherent problem with earnouts from a buyer's point of view and from a seller's point of view, that these are ingredients which are added to a mix and you can never disaggregate in years to come? The earnouts typically, in fact, I'll ask you, can you think of an example where an earnout has worked adequately, if not well, for both sides? Aren't there always one winner or loser, or a whole load of arguments over earnouts subsequently?
I think it's a principle overall. They are successful, but they do have you do have to take on board the reality, which is they're not something you're doing right now. They're something you're providing for in the future. And when you're doing anything that is providing for something in the future, that however well you try and tie things down, that there is an element of it's going to be relatively difficult to necessarily think about everything. And we've seen deals that were done 12, 18 months ago with earnouts that have obviously been drastically affected by the pandemic. So a live example, and where do you get to with that? Well, ultimately, at the end of the day, it probably is what it is, unless buyer and sellers can agree otherwise.
Yeah, so I mean, put another way around, a relatively backloaded deal, which was predicated on performance in 2020, which looked entirely achievable in 2018 or 19, suddenly is deleterious for the seller, because they're not going to get that uplift in value. That's essentially what you're experiencing.
That's essentially the short of it, unfortunately. And yeah, there have been sort of sad examples of that. Not necessarily completely wiping out earnouts, but you know, some have been more lucky than others, but certainly having an effect, definitely, I would say.
I think they can certainly they can help to, as much as they can help to bridge that valuation, the expectation gap between buyers and sellers. There are, particularly where you've got a business where the incumbent shareholders, the founders, are business critical to the goodwill and the trading performance. They are a mechanism through which a buyer can align the interests of the shareholders going forwards if they are continuing for a transitional period, a 1 year, 2 year transitional period, whilst the target company is the goodwill is amalgamated into the buyer's business. The fact that the seller has a potentially significant proportion of their cash output on the line, depending on how the business performs over the next 12, 18 months, they can serve to align the shareholder interest with the buyer's interest. So ultimately working towards the same goal. You do often see buyers they want the deal. Buyers don't want deals to be unsuccessful. They want the target to continue to succeed post completion. They want it potentially stretching performance figures. So whilst yes, there's a buyer's got to potentially come up with more cash to fund it, the better the performance of the target post completion generally bodes well for the buyer in terms of having executed a successful M&A deal and acquired a target which will support its growth journey, and the seller's working hard to deliver the number that results in a more significant capital output for them at the end of the transaction process.
Are there any complexities, thinking about the whole variety of loans, but particularly grants, which have come in through this pandemic time? Does that of itself change how deals structures are working, or multiples might work, either on direct exits or on earnouts? Or is that just a red herring? You know, if an organisation has had a grant, is that deemed to be some sort of, you know, inherent capital value which goes to any potential earnout ratio, or is that something you've not as yet experienced?
It is an interesting one, Greg, because I think it is starting to come through now. I'd say based on our experience, it is only just starting to come through, because businesses that have sort of grant funding or government-backed funding in place, that have been put in place relatively recently, you know, you would hope they took advantage of it, obviously for the right reasons at the right times, of course. But obviously there's technicality not just around the funding side of things, but things like, you know, furlough scheme as well that's been brought in. Again, a lot of businesses have taken advantage of, because, you know, that's what it's been there for. So, you know, you are right, all of those things do have to be unwound as part of the M&A process. Or I say unwound, they have to be gone through,
factored in some way.
Factored in. Whether it's a direct effect on value, I couldn't say. And I think because the main feature of these things is that, you know, they've been taken up and made available to a lot of people. I think it's relatively commonplace, and people are becoming more used to dealing with these sorts of things when they come up on DD as part of M&A deals at the moment.
Let's take a couple of questions we've had from our good friends, anonymous attendee. It may be the same person twice, who knows? It's anonymous. First one, I suspect, is maybe a straightforward one for you. If a business owns its premises, is it an option to sell the business but retain the building?
And yes, certainly on that, it's certainly not uncommon to see scenarios where the freehold premises that the business operates from is owned by shareholder directors, whether it's via pension schemes, via a separate investment company, and then a lease is put in place with the business itself, which then pays a market rent for the use of that premises. So it's certainly not unusual to see in practice. When it comes to an exit process and when you look to sell that business, what buyers will tend to be looking at is what are the terms of that lease. They need to be on arm's length third-party terms going forward that give the buyer some certainty. If you're, you know, signing, and I suppose, and if it's not, it's how does that play into the valuation? If the business has been paying a below market rent for the premises because you own it separately via another interested company, what impact has that had on profitability of the business over the previous financial periods? And so it potentially could be factored into the multiple evaluation if you're looking at it from that way, and it would be retrospectively adjusted what the profit figures were to factor in, well, what would a normal market rent look like going forward? So it's certainly not something that tends to be a showstopper in terms of transactions, certainly fairly commonplace. It's just getting the structure right, ensuring that the lease arrangements are sensible and on third-party arm's length terms.
And this is in part where great lawyers earn their corn, I suppose, is finding routes through potentially complex structures, whether it's property ownership or indeed share ownership. It's far more complex, and we'll come on to some of those points in a moment. Another question is, are there particular nuances, any particular nuances we should be aware of if buying or selling a franchise business? That stumped you.
Yes, short answer.
Yes, and they may be.
Slightly longer answer, Greg. Yes, I mean, I put our hands up on this one, and neither James nor I are franchise specialists. Within the wider business, we do have franchise specialists who actually they are working more frequently on deals which are they're either putting the franchises in place in the first place, but also more regularly at the moment buying those franchises back in. So in very general terms, they tend to be relatively sort of nice, friendly transactions, because you on both sides you understand what you're doing and how you have been going on. So it can actually, I don't want to underplay it, but it can be approached as more of a mechanical exercise sometimes than anything else on the franchise side of things. But I would say, because neither James nor I are specialists for good reason, it is one where it's worth talking to franchise specialists about when you're looking at something like that, in the market right now. Because I think there's definitely interest for doing that from some of the larger corporates who were revisiting their general operational structure and rationale for doing things certain ways.
Yeah, I think part of certainly one of the most sort of significant material difference with a franchise business as opposed to a non-franchise business is when you're operating a franchise, almost the goodwill, the brand associated with the business that you're operating is owned by the third party, by the franchisor from whom you've taken your franchise. So you don't own the goodwill associated with that brand, the intellectual property rights in that brand. And also then, as part of the sale process, normally generally sort of speaking, the franchisor, the franchise owner, will need to agree to the identity of the third party who's potentially coming in to acquire your franchise. So I think, as Ian said, it is quite a different transaction process, which is, absolutely sort of, you want to speak to individuals who have true experience and specialism dealing with those sorts of franchise transactions, because they can be quite different.
I'm sure they can be quite different. I mean, one thing I would imagine would be easier, and fully accepting you're not direct experts in this area, but others within Royds Withy King are. And one area that should be easier is due diligence, because there's been full disclosure of finances, one would imagine, up the line at least, so that a buyer would know what the prospect is. But anyway, we'll come to thanks to good old Anonymous for both of those. Please do ask further questions, and I'll keep prompting our two experts myself. Let's talk about M&A. Of course, isn't only about selling a whole asset or whatever. So talk through about some succession planning that you've experienced, you've advised companies on, whether that's founders selling down to in stages to their management teams or families or whatever. What are again, perhaps in slightly broader terms, what are the advantages and pitfalls of that staged approach, or selling to a near party, as it were?
Yeah, I think certainly from a founder's perspective, and in terms of actually realizing shareholder value, that succession planning is relevant to almost any M&A deal that you do, because the less essential you are to the business that you own, generally speaking, the better the price that you can often negotiate for that business, because you can be removed from it and it can continue without you. If the goodwill of the business and all of the key client relationships of the business, and you are too integral to the business's operations, a buyer looking at that business will be seeing, well, yes, there's a strong underlying business, but that one individual, that shareholder, that founder is so crucial to this. If for any reason they lost their motivation post completion, or they're looking to exit in their entirety and not continue with the business post completion, then actually the value of the underlying business is significantly diminished. So that succession planning piece, I think, sort of starts for any business when you're looking at that exit, that route to exit, whether it is 2, 3 or more years down the line, ensuring that you have, as a founder, alongside your management team, or looking to upskill a management team that you trust and provide some senior level decision making, and a management team that buyers will be comfortable with, know the nuts and bolts of how the business operates, important relationship to clients, etc. So it's ultimately important for any transaction, whether it is you're looking at a management buyout structure or a trade sale to a third party, having that succession planning in mind through the management layers within an organisation is always really important. I think what we have seen probably over the past, going back pre-pandemic as well, a significant growth in the number of management buyouts taking place in the market. And often where you've got that next layer of management is in place, they want the opportunity to put their own stamp on the business, take it in the direction that they think it can go in and deliver further growth, arrive at a time where the founders, yes, they're happy to exit. The management team might not necessarily have the finance available on a personal basis to deliver that transaction, but we're certainly seeing lots of appetite from, and historically seen lots of appetite from funders to back the right management team in relation to the right business. And it can certainly be done very successfully. You certainly see that that's what the private equity world, often picking the right management team they're looking to back and deliver growth for their private equity investors behind the private equity fund. It's about having that management team in place who inspire confidence that they can drive the business forward to the next level. And I think it sort of comes back to that as a business owner, as a founder. Generally speaking, you want to be sort of looking to exit when the business is still on an upward curve, not when it's peaked, because that's when the valuations start going down potentially going down the other side of the hill.
Okay, so for the company owners, senior managers and so on watching this seminar today, talk us through the process of how and why Royds Withy King is chosen, perhaps compared with other most capable legal firms that people may countenance discussing this exit with.
So why do people work with us, Greg? Well, the short answer is much the same way James was talking about in terms of on the buy side, backing people by people, and essentially what we do is our services are ourselves. It is us. It is the fit with us. It's the understanding, the confidence that we can give the support that's needed from the position that we sit in, based on our experience in the market, our credentials, and finding that degree of alignment, basically. Unfortunately, most, a lot of businesses, you do have relationships with lawyers on a day-to-day basis, but sometimes they're not relationships that you really want to be visiting all the time, because they tend to be about things that they're not necessarily the nicest things. So there'll be debt recovery sometimes, or there'll be disputes with employees, or they're not particularly sort of pleasant things to be talking to sort of day-to-day lawyers about. But on the transaction side of things, we're hopefully coming from a position where we want to be supportive. We want to we want to be standing there alongside, and we want to be able to offer our kind of our experience, our support, our ideas, certainly in the first instance as well, about how things can be shaped and put together to the extent that we can. But ultimately, again, coming back to it, you have to spend a little bit of time with us. I'm really sorry, as part of any process. And I think the most important thing is you actually have to be able to think, well, these are people that I can understand, and I'll be happy to do that with.
There's a paradox of M&A work, which is that your trusted advisors are with you very, very closely at every single stage. You get to know the businesses well, you get to know the management teams well, the market sector, etc., etc. And when a deal's done, your work is done, and isn't it odd that you've built up that expertise, the buyer or seller has built up that level of trust, but there's not really an advisory role typically for lawyers the other side, except on other specific transaction work. James, how do you see that advisory work playing post deal? Do you get involved much?
I think we certainly do. We've got sort of certainly on the buy side of M&A transactions. We have got sort of a number of clients that we've worked with on multiple successful M&A transactions, delivering buy-side deals for them, and have almost to the point you become part of, as you say, the deal completes. Actually, the paperwork, yeah, all nice, sort of bound together, looks smart. Everyone's hoping is then put into a drawer, everything goes smooth, and you never have to look at it again. Is always the hopeful outcome. It then sort of moves on to it is that integration process, and I think the thing sort of we always look to do is, yeah, the initial process in terms of, for a buyer just acquired a business, you're then, what happens immediately is potentially announcing it to all the employees, how you're going to approach, let key customers know. There are those key commercial aspects, but then there is the longer term planning around integration in terms of the sort of the legal matters. That might be harmonizing employment contracts of the target business's employees. It might be looking to bring some of the target business, their key employees, into potential share option schemes, incentives. How do we ensure identifying those key individuals? How do we incentivize them? So we look to sort of always try and have those conversations, or it might be during the due diligence process, there have been issues identified which not showstoppers in terms of a transaction, but nevertheless you need to deal with post-completion. So the typical ones in recent years have been to do with data protection, GDPR compliance, not necessarily being as good as it could have been. And so a buyer comes in, needs to remedy those issues that have been identified before they cause an issue down the line, which could result in value loss or impinge the prospects of the transaction succeeding. So from our perspective, it's almost picking the right moment. Sort of the buyers have always got an awful lot to get done post-completion. So remedying some of the legal niceties that came up during due diligence might not necessarily be at the top of the list. But nevertheless, we generally are involved in sorting that process out, picking up on the things that we identified, and ensuring everything is as it should be on a go-forward basis.
Good. A couple other questions we've had externally. There's a lovely word alert, which is if a business name and branding is eponymous, in other words, if the business is named after the founder, for those perhaps who are less aware, does this reduce its value and therefore appeal to potential buyers? And if so, is a rebranding ahead of a sales exercise actually quite sensible? And against that, there's many years of establishing that brand, as this questioner asks, and so you lose a bit of brand equity. So, would you typically advise renaming if it's called, by the person's name?
I'd say it's not something we see in practice as a material issue. I think you only have to look at in the market, and you see there's an awful lot, lots and lots of businesses out there still named after their original founder, were sold a long time. You don't have to look at the high street or look at the haulage industry. Lots of brands out there with names long associated with the founder. I think it's from the perspective of, I think what can be sometimes a little bit tricky for individuals where the business does bear their name. It's that in the transaction paperwork, you'll be having to you'll be signing up to restrictions in relation to the using potentially of your own name and business going forward, which can seem a little bit counterintuitive. But equally, from a buyer's perspective, if the goodwill is associated with that brand and that brand is your name, then the buyer expects to have exclusive use of it in relation to the business industry going forward. So it's not something we tend to see as a material issue in practice, but it's certainly something to be aware of in terms of what you'll be signing up to post-deal completion.
Thank you. But sellers come from a variety of different knowledge bases, whereas buyers on the whole are more experienced and know what to look for. We've had a question here saying, I'm very new to buying and selling businesses and don't totally understand EBITDA. Without getting into too much the technicalities, essentially there are multiple ways of defining what profit is, but could you just briefly explain EBITDA as an acronym for what? Go on, I'm going to put you through your paces. Earnings before interest, taxation, what else we got?
Depreciation, amortization is the... So it's the commonly used matrix for valuing a business's recurring profits ultimately or profits on an annual basis. So you're taking out almost what could be the extraordinary factors, sort of what the tax paid in a particular year was, how book value of assets, things like that. It sort of gets back to basics on what has the business made in relation to a particular financial period at its core. And it's the matrix that's been commonplace, certainly for as long as I can remember, for calculating that what business earnings are.
Yeah, so it's it's buyer beware, but also seller beware, and this is presumably also is where lawyers such as Royds, Withy, King would be essentially hand-holding people who are selling businesses, particularly if they only do it once in their life, to understand both the terminology, but really the process. Let's come to process. Insofar as there's any normal type of deal structure, yeah, there isn't, but anyway, could you just talk through, almost on a sort of pro forma basis, if someone were to approach you and they agree, blah, 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 the sale process, yes, we're going to kick it off, what might that entail? If we can keep it reasonably brief, because I want to come to the psychological aspects as well, please.
I mean, what I'd say on this, Greg, is that actually that presupposes you've got a sale process, and then you come to talk to us. Actually, what I think we've always like to assume is that we might be there a little bit before that.
Right.
Because
okay, talk through. So someone today thinking, gosh, I think now's the right time to consider selling, and they drop a line to you, how might that process go from here?
Yeah, so in general terms, I mean, it sort of comes back to the valuation question a moment ago. It's from our perspective, we take a lot of comfort from making sure that we're part of a team of advisors on deals generally. It comes back to what James was saying at the very top of the webinar about why we do deals in the first place, and actually making sure there's the right support in the right kind of areas. So on the accounting, the corporate finance side of things, as well as on the legals and generally, because particularly on the sell side, when it's a relatively new experience, it is going to be a bit of a team effort to get a deal across the line. On the legals, what do we do on the sell side? Typically, we help field questions which are involved in due diligence, which is kicking the tires on a business. We deal with transaction documentation. What does that basically mean in short? It means the mechanics of buying and selling shares, how you get your money, and what you are basically standing behind in terms of the value that is being paid. So the comforts, the protections, the restrictions that on the sell side you give to a buyer to say it's actually worth what you're paying for. Then just following on from that, because the buyer will want to make sure that they are getting what they think for what they're paying for, they are going to want sellers to stand behind the state of the business. So they'll want warranties, they'll want a tax deed, tax covenant generally, because they want some comfort that it is what it is. But we need to, again, on the risk side of things, make sure that sellers are appropriately protected. So not just through limitations against potential claims under the paperwork, but also the most basic of kind of principle really, which is if something is inconsistent with something you're being asked to stand behind, or a statement that you're being asked to give, tell the buyer why it's wrong. And that's what disclosure is. And that's where, again, we have a quite a significant role. Otherwise, there are lots of other more deal specific things that draw in often other areas of kind of our full service offering, real estate, employment, depending upon what's happening going forward, service agreements, consultancy arrangements feature, real estate, again, in terms of properties that are owned, occupied by a target group, target business, what's happening to those going forward. So there is lots of other sort of more deal specific things that get bolted onto that very basic framework. But in relatively straightforward terms, that's what you're looking at from the mechanics, overlaid with the whole kind of we need to deliver it as well, and fielding all the extra stuff that comes in around the outside as you seek to sort of go through that kind of process and deliver something successful.
Yeah. Clearly, there are multiple stresses and strains on deal-making processes, and one of the most intriguing elements, as we were talking about prior to this webinar, is the research which you've published jointly with Professor Scott Muller of the Business School of the University of London, he's a global M&A professor and experienced in M&A work himself. But it's about the psychological context for buyers and sellers, the inhibitors, the biases, and so on. Can you talk about some of those aspects and what have perhaps been the most surprising that you've seen through that research process and subsequently?
Yeah, certainly. I mean, it's something I think if you look into the M&A markets, there's lots and lots of great content out there for buyers and sellers readily available that talk through M&A processes, tax considerations, advice on corporate finance processes, and the technical intricacies of the nuts and bolts of M&A transactions. And I think what we sort of looking to come at it from a slightly different angle, and I think sort of back to what we were saying at the start, ultimately M&A deals, that they're built around the people involved. And yes, there's all the technical expertise that everybody brings to the table in terms of an M&A transaction. But I think as we've seen generally in sort of society in recent years, there's been a much greater awareness of unconscious biases and how they impact all of our decision making in day-to-day life. And so we sort of wanted to explore that in the context of M&A transactions. So yes, we partnered with Professor Scott Muller at the Business School in London to look to explore some of those sort of key biases and how they operate in practice. And I think I sort of remember my initial conversation with Scott, there's sort of a couple of sort of stats that he sort of provided that really sort of brought it home. It's I think in terms of everybody's constantly the overconfidence that tends to come into play. I think the stat there sort of research highlighted is that what people think is going to happen 98% of the time happens about 60% of the time. And similarly, I think is about 90% of people think they're an above average driver.
Yeah.
Which are the two, perhaps not entirely unsurprising, but sort of stats that really sort of bring to bear why that certainly the overconfidence in the markets or in people's day-to-day lives. And it's how that certainly comes into play in M&A transactions. And I think certainly from a buy side perspective, not all transactions succeed. And why not? There might be, you can go through a financial due diligence exercise, a legal due diligence exercise, exploring the target in lots of detail from lots of different angles. But sometimes you do end up with management teams making decisions based on sort of confidence, potentially overconfidence, overlooking issues that have come to their attention. Because I think certainly the general position, management teams, CEOs, MDs don't get to where they get to by making bad decisions. That confidence in business decision making and the belief that you're sort of trusting your inner gut when making decisions carries on into the M&A world and actually can lead to mistakes being made because either you believe you're the business, the individual, the team, that we can beat the odds, or you start overlooking factors that have come to your attention, but I think you sort of tend to see alongside the overconfidence, you get sort of this confirmation bias where, yes, there are these issues identified, but yeah, we think they're minor points. We're focused on this because this is all really good news, which underpins what we already thought, as we also see in everyday life decision making. But I think we really sort of started to see through this research how that impacts on M&A transactions. And yeah, there's a white paper that's been produced in conjunction with Scott Gregg, which I think is going to be made available after the webinar, which everybody can have a look at. There's lots of sort of interesting examples.
Yes, we will. In the comms after this, we'll give the link to that, because I mean, ultimately these are for all the complexities, the detail, the negotiations on this. This ultimately comes down to human understanding and emotions, and people's personalities and psychologies. Ultimately completely key, whether it's the inherent optimism which most CEOs have. It's inevitable in the role, but that's true on both buyers and sellers. Presumably you've also seen buyers who somehow think because they overrate their own capabilities, they think that if you simply put an asset within a larger organization, it will automatically be transformed to this greater, and so the lack of integration is sometimes the flaw when it comes to seeing value in deals.
Yeah, and I think it's certainly something, I think sort of the label sort of placed on that is this, and it is relevant to buyers and sellers, this illusion of control.
Yeah.
And from a buyer's perspective, the great target business, yeah, that'll work culturally. Yeah, we've got a great culture within our organization, like the culture of the target organization. Our people gel together, no issues, it's all going to work smoothly. Might not necessarily be the case. And similarly, sort of on the, I think sort of that's certainly something that when you look at back, probably linking that back to some of our conversations earlier about sort of earn-outs from a seller, certainly from a seller perspective, the seller's sort of belief that their clients, certainly in terms of generating revenue for the target business, well, they're loyal to the target business. A change of ownership isn't going to affect how our clients see the business. Of course, they'll stick with us. They won't reassess who their provider, their supplier of whatever product or service it might be is just because there's a change of control. We're comfortable. It'll all continue business as usual. That's something actually completely outside of the control of the sellers, because that emotional reaction of a client thinking, for example, a financial services business, an individual client who's might be using an organization of a small team of IFAs, small IFA practice, that's then absorbed by a much bigger practice. You never know how clients react to going from being a more significant client to a smaller organization, to a less significant client to a larger organization. And that's not within the control of anybody apart from the individual clients. But lots of the time, buyers, sellers think they can, you might be able to take steps to ensure that you minimize that risk or mitigate that risk. But fundamentally, it is something outside of the control of the individuals involved in the transaction.
We're coming towards the end of this, and there's so much ground still to cover. But one key thing about this research, how has that research and thereby your increased understanding informed Royds Withy King's approach to deal making?
Yes, it's a good question, Greg, because why are we interested in this, frankly? It goes back a little bit of what James said. We work with people on transactions, so having an understanding of what what the drivers are and what things are in play behind the scenes is actually quite helpful. It's also something that I don't think we will be expected to be thinking about necessarily, because from a legal perspective, effectively what we can do on a very basic level is we provide a service. It's a process. We get you from one point to another, and that's it. And in very basic terms, we do that and then we're done. But from where we're coming from is we like backing people, we like working with people, we like going along for the growth journey, wherever it is, whatever it is, in various forms over time. And so as part of that, we like to know what we should be looking out for a bit, in the terms of how we look at stuff, and also how we do our job, how we support on transactions, particularly due diligence. As part of a process, you might be asked to look out for X, Y, and Z on the buy side when kicking the tires and doing a DD exercise. But what happens when you put that red flag in the ground? What then happens to that recommendation? What does it then turn into? What then are the next steps? And what then is the 100-day plan that follows on post completion? And what then are you going to do after that? And actually thinking more, bigger picture on those sorts of things, because we know that actually in that white heat of that moment, when that red flag is put in the ground, it might not be the thing that actually is really the most helpful right then, because of all these biases that are in play. You're looking to deliver a deal, and we're all looking to deliver a deal. That's the other thing, coming back to why we do deals in the first place. We want to deliver transactions, and a lot of that is driven also again by the biases that underpin the way we think, the way we work.
And I'm sure you've experienced this on both sides. People's heads go after a certain point. They've bought that asset, even if they haven't, or alternatively they've sold it, they've checked out, and then they almost don't want to hear at that point. And your role is to be the voice of reason. Say, hang on a second.
You always hear that phrase. It's too late to back out now, and that's sort of the phrase that sort of.
And there's no such thing.
To be the precursor to sort of most things sort of that you don't want to occur.
Yeah, and there is no such thing. A deal isn't a deal until it's finally done. And you'll have seen deals fall over at the absolute last minute, and they may well have been right to fall over. But sometimes it's rare, but it can happen later on. A couple of last things in closing. One specific question for you. You mentioned about the deal range that you're involved in. Good old Anonymous has popped up again with, am I correct in thinking that Royds Withy King are not interested in overseeing the sale of businesses with a value below £3 million? That true?
Not quite the takeaway from that one, Greg. Sorry, not to confuse it. The sweet spot for transactional work is between 3 and 30 million. So that's where our sort of our kind of expertise more lends itself towards. But that said, we do plenty of deals below and also a handful above that range. It's just from actually positioning ourselves in the market, that's where we tend to see more activity. But it's not to say that we don't do deals that have a value, the sort of sub 3 million. No.
Yeah, I mean, I would suspect that if that particular anonymous attendee were interested, have a chat, and if they think you're the right people to take it forwards, and if you think that's the right level of business, fine. I would imagine there's not an exact cut-off point, and if something is an interesting asset from in a sector where you have expertise, then of course it's to be considered. But that's a guide rather than a firm range to that anonymous person. Just one thing back to the you mentioned kicking the tires a couple of times. Often that would mean going into a business of getting some sense of its culture, seeing what it's, what it looks like, and that isn't possible in current times. How has DD been affected by lockdown?
It has proved a challenge in some areas, I would say, and it's actually not just in DD, as part of general transaction process as well, where people can't actually get together and have a conversation, or at least meet up. You lose the extra conversations that take place around the edges when you do those sorts of things, and the more principle type points that get picked up. So we are missing that a bit, and those things tend to be dealt with later in the process through different channels, which bring their own challenges. On the DD side of things, there is of course an awful lot that can be done virtually. It's a bit like audit work as well. For accountants, an awful lot of it was already being done effectively virtually and electronically, and it just moved that forward a bit more. It's accelerated that. Yes, you're right. There is still need to go into businesses from time to time. I mean, would you buy something without actually being around to know where it is and how it looks and who the people are and where everything works and sits and all of those things? Well, if you've got to travel around the world to do it, probably not at the moment. But within the UK, I think most transaction processes have either done that at the very early days for the ones that are already going, pre we hit immediate lockdown, so they're working based on the benefit of that, or they'll be looking to find ways to at least go in safely to premises to meet up with people and see people and actually just get a general feel for it on a much reduced basis, of course. But it is still, from what we see, a relatively key component of any DD process.
We are over time, but we have had a couple more questions I just want to take. At the head of this webinar, it was said that the ultimate outcome for any M&A transaction is a successful outcome for shareholders realising capital. We're all aware that the OTS, what's the OTS? I'm afraid
Office for Tax Simplification.
There you go, Office for Tax Simplification. It's been simplified to an acronym. Have looked at how CGT could be reformed, bringing it into line with income tax has not been ruled out. Therefore, it does come to a question. Therefore, a business owner who pays additional rate tax and who sells their business for, say, a £3 million gain could pay almost 3 times as much tax, 1.35 million, against 500,000 if CGT is aligned to income tax. What advice would you give to your client? If I may, it is a complex point, but take the underpinning point about how you advise on the financial structure of deals to be as tax advantageous as possible to sellers.
I think certainly on that, that's where our advice be. Speak to a good tax advisor who can sort of do some modelling on that and what the different transaction outcomes are in that sort of context. It was actually something I was on a call with a client and tax advisors yesterday, talking about pretty much that sort of thing. We're involved in a transaction process and the timing of completion. When's it going to be? And I think it's sort of, as it happens before every budget, there is always a nervousness over what is going to happen to capital gains tax. Entrepreneurs relief did change last year, but that had been speculated about in relation to about every budget I can certainly remember going back a decade. So these changes are always sort of hinted at, but it is crucial as part of that transaction planning, as Ian sort of mentioned, in terms of, in an ideal world, sort of on, certainly on the sell side, as lawyers, we're part of the journey leading towards that exit point. You want to have the tax planning as part of the journey towards that exit point as well, so that everybody's working together towards that ultimate goal, and these sorts of obstacles can be, if not foreseen, at least have a plan of action in place to know how we're going to, does that prompt a change in a transaction structure to try and mitigate some of that risk?
Well, you mentioned that many points, and guess what? We're at the exit point of this webinar, unfortunately. I say unfortunately because I think personally think it's been an excellent session. You've talked through a whole load of different elements, from the psychological to the practical to the structural to valuations, and there's much more, of course, which we could cover. But I'm going to call it to halt at this point. And our thanks to you both, James and Ian, and to Royds, Withy, King for today. Thanks to everyone watching live and asking questions. You had some good questions today. Or indeed watching it on YouTube. It will have this afterlife, and the insights here will continue to give value to people subsequently. Thank you, everyone, and good luck in the coming months. And as you reassess and perhaps rebuild your businesses in those coming months, please do look out for our business surgeries, the opportunity to go into a deeper dive and showcase an expertise such as this, our clubs, our Bristol Life Awards, our Property Awards, and of course, Bristol Life itself, which is yomping towards its 300th issue, which is a great landmark, which we're heading for at the end of May. This has been a Media Clash production, and this has been a Bristol Life Business Surgery. Bristol together, always. Thank you.